All right. So to put the implied comps in for Microsoft, what I'd done is I'd taken the Excel file of the multiples that we had downloaded from Bloomberg. I added that in as the last tab in our model, and I called it multiples. Right? And so what I'm going to do here is I'm going to take this row right above the market cap weighted average, and what I'm going to do is I'm going to call this the implied multiples, or the implied comparables, or implied comps, or comparables, depending on how you want to pronounce the word. So the idea is that these multiples are based on actual market data of the stock prices of the companies in the real world today. But in our model, we are forecasting a stock price of Microsoft. Well, we are forecasting an enterprise value, as an example. We are forecasting revenue. We're forecasting EBITDA. We're forecasting EBIT. We're forecasting essentially earnings per share because we're forecasting net income. So we're forecasting a PE ratio. So that's the point. Our model implies a multiple. Right? So what we're going to do is we're going to say, given the share price that our model is calculating, what multiple would that be? So we're going to look at the model multiple, or so instead of implied multiples, you can also call this the model from the model. And how does that compare to what we see in the real world? Okay, so the first multiple is enterprise value to sales. Now, one word about our model is that the enterprise value we use in the model is different than the enterprise value that is used by practitioners in the real world. So, here's what's different. If I go back to Bloomberg, and I go back to enterprise value, I can find on the FA screen, the very first tab when I go to financial analysis for my company is enterprise value. And if I click on enterprise value, actually I think I got to click on the number. If I click on a number for enterprise value, try it this way. If I right click and click on definition, it'll show me the definition of how Bloomberg calculates enterprise value. But specifically, it's right here. It's the market cap of the equity, it's basically share price times shares outstanding, plus the preferred stock, plus the minority interest, plus the short-term debt and long-term debt, minus cash and cash equivalents. Okay? So, what does this basically say? What are they doing? Translate that to what we've been calling the star class, our 1, 2, 3, 4s. How are they calculating enterprise value that's different than our 1, 2, 3, 4 model? Because in our model, 1 plus 2 equals 3 plus 4. They're doing 3 plus 4 minus cash, basically. That's what their definition is. They're using cash as a proxy for the 2s. Because they're basically saying cash is non-operating, and so therefore what we're going to do is we're going to take enterprise value minus cash. Matter of fact, the similar ratio is when people call it net debt. So net debt is debt minus cash. Okay, same idea. Is you're netting out the cash against the debt, you're netting out the non-operating against the debt, and that leaves you, if you add in the equity, leaves you the operating value. So in a way, what Bloomberg is trying to do is get towards the operating value of the firm, assuming the firm doesn't have a lot of other non-operating assets of any value, all right, which is true for the vast majority of firms. So therefore, this is why this has become the ratio that is used in the real world. So in a way, it's similar to what we're calling operating value. I say similar and not exact because we're saying some of that cash is operating cash and can't be paid out. Bloomberg and CapIQ and the other data services say all cash can be paid out, which sounds great in a classroom, but in the real world that would never happen. So that's a nuance that we're applying in our model that the real world also doesn't apply to this definition. So here's what we're going to have to do though. If I want to sync up to this multiple based on what I do in the model, then I have to make a couple changes. So here's what I'm going to do. I'm going to come up with, I'm going to do this on my DCF valuation tab. I'm going to call this the Bloomberg equivalent enterprise value. Right? So this is the enterprise value that Bloomberg would have calculated. So Bloomberg would have said, take, and I'm just going back to the formulas, take all of the market value of equity and all the debt, and then subtract the cash. So basically what I'm going to do is take my common equity value plus all these liabilities. So really, I can take my, actually they take, sorry, equals, I'll use the actual definition because they don't take out retirement-related liabilities, equals common equity value plus, they also don't deal with operating leases, minority interest plus preferred stock plus interest-bearing debt. Right? That just following the Bloomberg definition, minus cash. Well, they actually use all of the cash. So I go back to my balance sheet, and for 2013, I subtract the excess cash and I subtract the operating cash because they're subtracting all the cash. And that's what I would call the Bloomberg equivalent enterprise value. So calculating the same way in our model that Bloomberg would calculate it. Does everybody see what I just did? Again, I recorded this as a screen capture, trying to recreate this. So, what are we saying? Well, we're saying enterprise value to next year's sales. So again, off the income tab, that would be 2014 sales. I'm going to make this a little bit smaller so it's easy to see what I'm doing, at least structurally. So what I'm going to do here is in the multiples, take my enterprise value, which is my Bloomberg equivalent enterprise value, and I'm going to divide by, from my income tab, 2014 sales 1. Got an extra mouse click in there. Divided by sales 1. Equals enterprise value to sales 1 and equals where is it? Enterprise value to ratios, income, sales 2. And I'll make all of these 2 decimal places. Enterprise value to EBITDA, income 2014 forecasted EBITDA, which is row 7. Row 8 equals, where is this? EV divided by 2015 EBITDA. Same thing, enterprise value to EBIT. (2014) operating income equals enterprise value to 2015 operating income, PE ratio equals the price per share, which is the common equity value, divided by the income, which would be the 2014 net income before extraordinary items. And next year equals common equity value divided by income 2015, net income before extraordinary items. All right. By the way, the other thing we want to probably do with the PE is take any, if you look back here on the income tab, we also subtracted out any net non-operating gains and losses. If you remember that in Bloomberg, when they do earnings per share, they're doing adjusted earnings per share so that you can take out non-operating and one-time items. So we also should be excluding the non-operating items as well, because the analysts in the adjusted earnings per share would take out the non-operating items, the one-time items. So essentially, I want to take out, if I forecast any non-operating gains or losses, so again, I'm subtracting non-operating losses, I want to add them back in to the earnings. So basically, I want to take income in the denominator, H15, and add in from the income tab 2014 non-operating gains and losses. And do the same thing, which was that, income row 12. So plus from the income tab 2015 I-12. All right. Price to book ratio equals price, which would be from the DCF valuation, the common equity value, divided by book equity, which would be for the balance sheet, which will be my 2000 and I believe price to book is calculated based on current book value in Bloomberg. So basically my share capital plus retained earnings. So share capital, which is row 31, plus row 32, which is retained earnings. So that will give me the price to book ratio. Right? So here's the point of the implied multiples. When you do section 4 of your presentation and of your paper, then what you're going to have to do is you do your as-is valuation. You give me your assumptions. You do your final valuation. You give me the change in the assumptions and why you made those changes. You pull out the ROIC chart. Well, you do buy, sell, hold based on that. You pull out the ROIC chart. You defend your buy, sell, hold. You defend your final stock price with the ROIC chart. And then you pull out the implied multiples. And you tell me why the multiple implied by your final valuation is reasonable given the multiples that the market is paying in the real world today. Right? So let's go back to this list, and it'll probably be easier to see in Bloomberg. But if I go back to Microsoft and I go back to our implied multiple list that we were looking at, just so it's easier to see all on one screen, and I add back the market cap weighted average, then the point is the average firm is trading at an EV to EBITDA of 9, and there are some companies that are trading as high, Salesforce at 32. But let's say we came up with a valuation where our EV to EBITDA was 5 for Microsoft. And we were just being very pessimistic about Microsoft's future. Well, that's probably not realistic for a price that people are paying for Microsoft today because it's well outside the range of anything that is being traded at in the industry. So we would be an outlier to data that's in the real world. So I'm not saying that we're not correct, but there's a lot of other people that are going to be wrong before we're right. And these are people that are following these companies professionally with a lot of data that's publicly available. So, just like somebody goes to the horse track and bets on the number 3 horse and they're a 30-1 favorite or 30-1 against to win, they're not the favorite and they win and they bet on them because they like the color of the horse or the look of the horse and they got right. Well, we can do the same thing when we do valuation, right? But I'm just saying that there's a reason why that horse is 30-1, and every now and then, 38 times, it's going to win. But most of the time, it's going to lose. And that's the point with the implied multiples, is that the implied multiples are basically what I'm willing to pay for growth in ROIC going into the future and what that translates into cash flows. So there's kind of a range of expected cash flows that people infer for this industry that are showing up in these multiples. And if we go well outside that range of expected growth or expected ROIC, then we have to have a compelling reason for that. So I'm not saying that we can't have a valuation outside the range, but it's just a second sanity check on the valuations that we do. Because if we have a company that's currently trading at a discount and suddenly our valuation says they're trading at a premium, then we should be looking at other companies that are trading at a premium and saying, hey, we should be getting the same types of ROIC and growth as those companies, and here's why we think we can do it. Because if we can't make that compelling case, then why are we suddenly saying this company is worth a premium when before they were trading at a discount? Right? Because we have to have a rationale to support it. So it's just another basis for helping you with your valuation. It's called implied multiple. So it's based on our stock price. And so what we're doing here is we're just setting up our model so it automatically will calculate this. So back to your assignment. What was the share price we were supposed to get from Microsoft in the assignment?
37.64.
Okay. So 69 is obviously not the right price. This was the baseline. So we had to get to $37 plus or minus. How did you guys get there? What types of rates for growth instead of 8 and 7%? What'd you put it down to?
I don't know off the top of my head, but I think it's probably 4, and then tapered it off, probably to 2, and it was negative towards the end.
All right. Well, let's say you get down to 2. Here's another thing, and let's say you can get down to 0 growth. Another thing that we didn't previously talk about is on the assumptions tab, we have a long-term growth rate, which is what the company is going to grow at in the long term, CVG. And right now, if I believe that Microsoft is going to go down towards 0, then maybe they're not going to have 3% growth into infinity, growing at the market, if they're in an industry that's not growing. So maybe I put that at 0, and oh, by the way, now I'm at $42 a share. So no growth into the future also will start to reduce the value of the company and the growth of my model. But even if I'm at 42, I got to get to 37. They're probably going to get some additional deterioration in their margins. So cost of revenue continues to go up. We're using that as the proxy with SG&A. Let's say that goes to 25. And then let's say it goes to 27, 29. And then somewhere around there, I get to around $37 a share. It's like watching Emeril Lagasse cook, isn't it? All these, throw a bunch of things, and suddenly you get the right recipe. All right, so, damn, yeah, exactly. Got to put some wow, or what's it called, BAM in there? What's the spice? So back to Microsoft. Notice what just happened to our implied multiples. Now, we're much closer, 2.93 against the 3.03 that they're trading at. The 2.72 next year against the 2.81. So now our implied multiples start to make sense, even the PE multiples. And the price to book is within 0.1 of the actual price to book of Microsoft. Again, our stock price is a little off, but that's the point, is that now our implied multiples and the actual multiples are back close together because we're doing our as-is valuation. Right? So here's the real question, though. What is the final? So now we've done our Microsoft as is. What do we think they are buy, sell, or hold? So this is more opinion than fact. So what did you guys come up with for that? And by the way, I'm going to pause the video here so you don't have to worry about being recorded.